It seems like both the S&P 500 and the Nasdaq ETF, the Qs, are headed for another leg towards the downside. For those of you who have watched my previous video on the technical analysis of the markets, I hope that you have been prepared for this move downwards, especially when you guys have seen the development over the last 2 days. Especially this huge red candle over here that formed when it touches the resistance level at the 20 EMA, and immediately the selling pressures continue downright. So in the last video, I've done an analysis using the Fibonacci retracement and shown that for the impulsive wave that we have here downwards, the subsequent corrective wave, the relief rally that we will be experiencing, should more or less meet resistance at the 61.8 level. And this is the daily chart of the Qs that we are looking at right now. Indeed, this is what has been developing on the charts. So what is new on the charts is the downtrending resistance line that I've drawn, and this trend line should act as another level of resistance as well. It also corresponds very nicely with the 20 EMA over here and the candle that develops on last Thursday. So this downward trending resistance line has been tested a few times as well, once here, twice here, and the third time here. Right now it will be the fourth time. Where is the charts heading next? Let us take a look with another tool, which is the Fibonacci extension. Now let's see if the previous waves have been obeying or have been following the Fibonacci extension levels as nicely as the retracement tool. So for our first corrective and impulsive wave, this is what we have: the downward impulsive wave, the upwards corrective wave. And then subsequently, what this does is it measures the next level where the next impulsive wave is going to bring us to. And we can see the next impulsive wave bring us to this, which is the low of this huge green candle over here at $318. It does not correspond to any Fibonacci extension levels that is being marked out on the charts at all. 61.8 is over here. It briefly breaks the 61.8 level, and with that, I wouldn't say that the Fibonacci extension tool will be a very reliable tool to estimate where the chart is going to head next. But nonetheless, let us just, for the sake of it, take a quick look at it. If we were to measure the next wave, where it is going to bring us to, we will have something like this. The start of the wave being at this point over here, the impulsive wave, the relief rally, the corrective wave. So we can see the 61.8 extension level is at the previous low. That could be one support level for the next downward, for the next down wave. And that will bring us back to 318. And after that, there is no more support level all the way until the 100% Fib E extension level. That will correspond to a price of about 298 or close to 300. That 300 level will further act as a psychological level, being a whole number, so that should be the next key and strong support. Now there could be some unclear support levels in between this zone over here that we have not been able to pick up. If there is, then that will act as another support to the downward pressure of the prices. So now let us take a look if there is any supports in between this zone over here. Now on the daily chart, one glance at it doesn't seem very obvious, and it doesn't seem to have any support levels for the prices at all. So let's head to the weekly chart and see what we have. Now on the weekly charts, likewise the 61.8 will correspond to the low of the previous wave, and it also corresponds to the 100 moving average on the weekly charts. And beyond that, we don't see any clear support level. You might say that there could be one at about 308 or 310. But other than that, I would say that the last level of support that we have would be 320, 318, and then the next level down would be 300. Now, personally, I hope that prices do not develop to that level and things could remain more on the bullish side, and we could see the end of the correction, the end of this semi-bear market soon. Now, just some interesting things to share with you guys. If we turn on to the monthly chart on the Qs, we can see that right now, since the top have been made, it has been 3 consecutive months of bearishness. Now this is the third month, March, and if we take a brief look at the history, we will see that it is not quite common for us to experience such consecutive months of bearishness. The last time will bring us back to 2018 at the October to September to December period, where we also have the top being made by a very tiny doji similar to what we have over here, and followed by 3 months of consecutive bearishness. And afterwards, prices have reached the bottom when they touch the 40 EMA, and then price reverse back up. Now if you take a look back then, prices have corrected from top to bottom a total of about 23 to 24%. And this time round, we have quite similarly, from top to bottom, it is about 21.8, close to 22%. So hopefully this does mean the end of the correction soon, as compared to what we have in 2018. Just a mini bear, nothing too big, nothing too serious. Now, besides 2018, the next time that we have this occurrence happening would be all the way back to 2015. We have another small 3 consecutive months of bearishness, and then it will be all the way back to the 2008 financial crisis over here. So hopefully this does mean the end of the correction soon, and hopefully it presents some hopes to the bulls out there. If we move on to the SPY, similar story, nothing much deviating from the Qs. And if we take a quick look using the Fibonacci extension, let's see if it obeys the FibE levels as nicely as nicer than the Qs, and it seems like it does not as well. The low of this candle, the low of this wave being made has already exceeded the 61.8 level. Subsequently, if we were to just to project this into the current wave that we have, will be a similar story as what we have been seeing in Qs. Now let's just go over to the weekly chart. Yep, so likewise, the 100% FibE level will correspond with the 100 moving average, the yellow line in the weekly chart. And if prices were to hit there, that would mean a total of 18.6, close to 19% correction. Still not in a bear market yet. And if we were to break the 100 FibE level, then the next one would be the green 150 moving average, which is correspond to the 161 FibE level. And by then, we would be in a bear market already. So let's hope that things don't hit there. Alright, so I hope this quick little update has been useful to you. If so, make sure to leave a like and subscribe to the channel. Personally, for me, my portfolio has been under quite a tremendous pressure since the start of the year. It has been down quite a lot already, and right now a lot of my bull put spread are being rode on continuously, hanging on, waiting for the next reversal into the bullish wave. Like what I've pointed out in the previous video, ever since development of this bearish candle on the 20 EMA, I've already started to take bear call spreads on my trading portfolio to hedge against further bearishness, and also at the same time to earn some premium so that I can continue to roll on my losing bull put spreads, and at the same time also earn my account some excess liquidity. Otherwise, you can see net liquidity has been dropping a lot, and my maintenance now way exceeds my net liquidity already. So if you guys are interested on how to trade the bull put spreads and also on the risk management side of things, do make sure to check out the strategy guides that I have uploaded on the channel. The links to those videos will also be in the description below. And with that, we have come to the end of this short mini update. Once again, if things has been helpful for you, do leave a like and subscribe to the channel. Also comment below and let me know how you think the markets is going to develop from here on. How all this geopolitical news is going to affect the markets in the near future. With that, I look forward to seeing you in the next video. Thanks so much for watching. Goodbye.